Hello and welcome everyone to this milestone of a video. Milestone in the sense that this marks the beginning of the end, in the sense that we will be starting the final unit number 5, which is finance today with this video. So, finance, something that we keep hearing from the first video. Company needs money. They need to make sure they need to pay their bills. They're earning things. Profit is a finance thing. So, we've been talking about it, beating about the bush, that what exactly finance is all about. And now we're going to make proper sense of it. And to fully understand where finance takes root, I want you to go back to the very first thing that I discussed with you on a business, that a business first needs resources or the factors of production to do anything, right? They will first need a piece of land, so set up a factory or an office for people to work there, that's labor. They will need machinery to do all of this. You need money. Even to conduct research before you start your business, you will need some level of money, of finance, to be able to do that. So, finance is the very basis of a business. And it's there for all the departments to report to how they are operating, and exactly whenever they need money, finance can provide them with it. So, making sure that they keep a good check and all the close tabs on where the money is coming in from, and wherever it's going, it's all recorded and accounted for. That's what finance is all about. So, in this video, we're going to establish the need for finance for a business, when and how a business can make use of the finance department. And there are two big parts to that. First of all, a business will need its finance department most crucially when it is setting up, so for something called startup capital. In the beginning, you would, like I said, you would like to buy a piece of land, set up an office there, get people in to work, set up machinery, set up a store or whatever. Even if you're setting up a lemonade stand, you're going to need some money to set up a table, get in some juicers and whatever you need to start up your business. So money is definitely needed even before the business is up and running, and that form of money is called startup capital, the money that is needed right at startup. Secondly, is known as working capital. Now, this is exactly how the name suggests it, that this is the capital you need to make sure that your business keeps working, the business keeps operating, the business keeps seeing the next day's light. That means you need to make sure that you have enough finance, that you are covering all your costs and still making some money to keep you interested in that business. So, keeping the business going, that amount of money is known as working capital. And we'll discuss this in a little more detail in a bit. So, the two big aspects that finance department helps a business with is, first of all, in setting up. Secondly, make sure it keeps running. So, as we discussed on our last slide, that finance department has to make sure that they're providing each department with enough money for whenever the need arises. For example, if the operations department needs to buy raw material in the piece of wood, that's available. If the operation department needs to start delivering goods to people's homes, and maybe the marketing department suggests that that's a new service that we should be providing, you'll probably need a delivery van. So, what I'm trying to get to here is that there are different levels of expenses that come up within a year. And the finance department has to make sure that they are providing enough money that those expenses are properly met. Now, within a year, there are many types of expenditures, so it's very difficult to really understand where all the money is going. So how they divide this is that they categorize their expenditure into these two categories. First of which is called capital expenditure. Now, this is expenditure or simply spending money by the business on those items which will stay with the business for a period of longer than 1 year. These are also known as your non-current assets. So, a building, you don't switch your offices or your factory every 2 or 6 months. We would like to be there for a longer period of time. You set it up that way. So, that is an example of a non-current asset. And when you spend on buying that non-current asset, the money that's spent is known as capital expenditure. And this is something that you see appear in your statements of financial position. The other category is known as revenue expenditure. This is for things that keep coming up within a year many times. So think about your raw materials. You keep buying them every now and then. You still pay your wages to your workers every month. So these are expenditure on those things that recur within a year. So they keep coming up again and again and again, which are also known as your current assets. So two types of expenditure: capital for the longer period, revenue for the shorter period. So working capital, we saw on the first slide of this video as well, is a very crucial part of a business, because without this, the business does not survive. The business does not go to see the next day. Literally, it ceases operations because there's just not enough money in the business, and nobody likes that, right? So working capital, that amount of capital that's needed to pay for your day-to-day operating costs of the business. If you can't even pay for your day-to-day operating costs, then really you're going to have to shut down very soon. So finance has to make sure that they are managing this side of the business very carefully. And the way to do that is they use a simple formula here, which is working capital equals current assets minus current liabilities. So if we take an example here, we can clearly see that our current assets are 1,000. So my working capital would simply be 1,000 minus 600 of my liabilities. So my working capital is $400. Now what that means here is that your liabilities, $600, are obviously debts that you owe. This could be in the form of a bank loan. This could be a bank overdraft. Could be in the form of creditors asking for money. So this is money that you know you have to pay, and you have $1,000 to pay for it. So it may be in form of cash, maybe in the bank, trade receivables. And when you pay for them, so you pay for your 600 out of the 1,000, you still have $400 left in the business for anything else that comes up, any surprises. So that's good, giving yourself a little cushion, a little buffer that there is some money to fall back on should the need arise. So maintaining this balance is known as working capital. Because if this wasn't happening, if let's say your current liabilities were exactly equal to your current assets, and what you have is $0 remaining, which will make your company an illiquid company. Illiquidity is something that no company likes. What company likes is liquidity. Liquidity means that you have enough money in the form of readily available cash to pay for your day-to-day expenses. So if you have that, which we had before this went up to 1,000, when it was 600, you still had $400. You had $400 worth of liquidity. That's the amount you still have ready should a need arise. But if you don't have any money left, that means there is no liquidity, no cushion to fall back on. If you have to buy more raw material, you have no money. When you have no cash, you are called an illiquid company. What you need to be called is a liquid company. So liquidity then becomes a crucial objective of the finance department. It is maintaining the ability of a firm to be able to pay its short-term debts, things that come up on a weekly or monthly basis. If you don't meet your debts, then you are forced into liquidation, which you may also know as bankruptcy, or simply closing down and going home, Jack. That's what liquidation is. This is when a firm ceases trading. So because you didn't meet your short-term debts, there are no more people coming to you. There are more liabilities than assets in your business. And because of that reason, whoever you owe to, for example, a bank, seize your assets and start selling them off to pay your suppliers or anyone else that you've owed in the business. That is a situation called liquidation. Nobody likes that. So maintenance of working capital is very important, because it's okay to be a loss-making company for a few years. A lot of companies do that. In fact, it's a matter of strategy sometimes that we will bear losses. A lot of these tech companies have all had investors put billions of dollars in it, but they still keep making losses for a few years because it's for your long-term growth. But even for those few years, if you don't have any liquidity, if you don't have working capital, if you don't have cash, you cannot operate, you can't pay wages, you can't buy inventory, you can't rent offices. So liquidity is extremely important. So maintaining your cash at the cost of profits is fine in the early years of a business, because once you establish, once you have all your systems going, profit will come for you.